All right, so for the second time in 3 days this week, we gapped up to the upside with a good move and held most of the gap throughout the day today. Now the question is whether we'll hold it by the end of the week. And so far, the signs are looking good. There are some indicators that are pushed to their limit, so we haven't pushed through yet. So I'm going to show you what those are and show you how bullish that makes us and what we can expect to see. We're also going to talk about what's driving. Was today's rotation confirming the leadership of the market, or is it showing us what could be coming in the short term? So I'm going to break that down, what the leadership is, why it's the leadership, and why we want it to be the leadership going forward from here, and what our expectations are, not just in the short term based on these technical charts, but what our expectations are going forward from here in terms of the intermediate term and beyond. So let's go ahead and get started. Today is Wednesday, May the 20th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. There's our rally getting up through Monday's high point, so new high for this little recovery period. Nice, good. Again, small range when you consider like how much of this trading today occurred during the trading session. You can see the total gain on the S&P was 48 points. Almost 49, almost 50. The range was over 26 points. If you look at SPY, the range was, or the gain was a 5-point gain on the day, 4.96, and we had a 2.3 point range. So again, most of the move on SPY occurred overnight. Second straight day, we can say that for the S&P 500. Or two, not second straight, 2 out of the last 3 days. 2 of the days this week. Bracketing this extreme low that we got yesterday on the momentum line. So, but regardless, the intermediate line did turn up higher. It is in the upper reversal zone, so right now it really doesn't matter which way it goes. But it is, when it does go up higher, it's more likely to stay in the reversal zone for a while. So, and that reflects a strong bullish posture. We got dark green shading, dark green line still, all across the board. The Dow is showing the same thing. The NASDAQ is breaking up through that 78% level. Very, very good breakout sign for the NASDAQ. And then the Russell still struggling, but the Russell's always going to struggle, right? That's, there's always this chatter about the disconnect between the stock market and the Russell. Well, it's not a disconnect because it's it's one really strong sector right now in the stock market that's driving a lot of the gains, and this reflects the broader economy. Like the Russell 2000 reflects the broader economy and what's going on there, and it's still hovering around half the loss that we got and during that decline. So yeah, the economy is still struggling, and the economic indicators are lagging anyway. But the Russell 2000 shows that the economy is still struggling to come back. But the cues suggest that not all of the stock market is struggling to get back, and there's a difference there. And we don't trade the economy; you trade the stock market, and the stock market shows a strong bullish posture with rising long-term market sentiment. In fact, the long-term market sentiment is at 43 on the Dow. It's at 40 on the Nasdaq Composite. That it's almost close to crossing above 50. So a very, very significant move in terms of recovery here. Of course, the Russell, which again measures the broader economy, is down 30%. So that's the issue, and that's why for example, a lot of our trades lately have been more in the technology space rather than other sectors. Even if we did dip our toe in the home building sector here lately. You take a look at its short-term sentiment. The near-term line is down a little bit today, but still upper half. The momentum line jumped up, but again, and this is why I tweeted out yesterday. The issue with the momentum line is we've had since we peaked right there on April 17th. That was pretty much the end of the rally, and then we've been sideways ever since. And a couple of up days this week, but pretty much been sideways with an upper tilt since April 17th. But the rally from March 23rd to April 17th really was the rally. Since then, we've had 4 times where the momentum lines dipped to extreme lows. 4 times. 2 other times where it dipped below the 10th percentile. So that's 6 times below the 10th percentile, with 4 of those being extreme. And not a single move into the upper reversal zone at all. And it doesn't have to. The momentum line doesn't have to get in the upper reversal zone. You would just like to see it do that after hitting extreme lows. To kind of like nullify the effects, the red flag effects of these lows. So, and we haven't done that. And every time it's gone up, it's gone into the reversal zone. Now, the near-term line has made a few, good near-term runs during this bullish decline, and it's looking like we're getting at least a slightly higher high, if not more, eventually on this particular near-term high compared to the last one. So short-term sentiment, looks good, but still not like, it would be really good if we can get a good momentum line into the upper reversal zone. And you would think that we would have got that on Monday. And the reason why we didn't get it on Monday is because most of the move during the day occurred overnight. And that's what keeps the momentum line from hitting lows. You can see it's better to get a bigger move, even with a gap. It's better to get a bigger move during the session than it is the overnight session. And this is the other way around here. So we want to see good size moves, especially when you've had some pretty decent sized moves during the day on the downside. We would like to follow those up with good size moves during the day. So in other words, big bodies, big candlestick bodies on the upside. And we just, like you can see, for the last couple of weeks, all the upward moves have had really small bodies compared to the downward moves, which have occurred for the most part during the day, during the trading session. And that's why we're getting more extreme lows in the momentum line than we are even getting, good solid overbought highs on the upside. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over the subscribe button right here in the bottom right corner of your screen and hit the red subscribe button that pops out. Also, if you're watching us on YouTube, there's a subscribe button right below the video. That will notify you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. Number 1, you liked our video today. And it tells us if that you want us to do the video again tomorrow. If that's the case, click that thumbs up icon. If you don't really care, or if you don't like our videos, then you don't have to click on anything. Also, while you're down there, comment. What did you get out of our videos today? I'd love to hear any questions or comments you have on the things that we discussed today. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter at DavidSettle42 for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Can't talk. If you're watching us here on our website, check out some of the other things that we have going on here, including our Market Outlook live trade review videos. So we do a live video every day that I do the Market Outlook video. We do a live trade review video at 3:30 Eastern Time. Right before the market closes, we review all the old trade ideas that we've done. We continue to manage them until the time that we close them. And then we put on today's trade idea that you'll hear later in the video before the market closes. So we've already put on today's trade idea today. You'll find out what that is here a little bit later. We also have our class schedule over here to the right. And then we invite you to engage with us on social media. Click this heart. It opens up this window. Hit that like button. Click that thumbs up icon. Opens up a new tab. Like today's Market Outlook Facebook post. Again, that benefits us because the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers that follow our account. It also benefits you because they will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now back to the charts. Let's take a look at the long-term chart. Remember that weekly Hakinyashi candle, it's kind of flirting. The close is flirting with that 200-day moving average. It's also flirting with these highs right around 29.54. Obviously, we're closing at 29.71, but the Hakinyashi close is only at 29.44. So we got to continue to get some upward momentum the rest of this week to pull that weekly close up. That weekly close in the Hakinyashi is an average of 4 prices. The weekly the candles open, high, low, and close averaged together. That's what comes up with the Hakinyashi close, candle close. So the more bullish we are by the end of the week, and we close near the high of the week, the more that average will move up. And again, getting above those highs will be that's a pretty significant breakout. It's still a bullish candle. We look for higher highs, higher closes, and no lower shadow. And that's a bullish candle. When you get one, you tend to be followed. You can see you tend to get more coming after it. So very, very good sign from that perspective, even if we're still kind of flirting with the 200-day moving average. We don't want to just flirt with it. We want to get above it, right? When you flirt with it, it's just a question mark of whether we're going to break. You break up above it, there we go. Right now, even with pullbacks, we can hold it, hold that line. So if you go back, you have to go back a little bit further, but you can see when you get above it, great. When you get above it, great. When you just flirt with it, as you can see on the downsides, then they tend to reverse. And so we don't want to flirt. We want to get through it and stay up above it if we're going to maintain bullishness here. Remember, the QQQs already have. So that's the sign. The QQQs, it got back up. It flirted right there, but then it busted through the week of April 13th in a big way. So that's a good sign, right? That's a good sign that it will hold it. And obviously, it's done more than just holding it. The momentum is really picking up. I mean, you look at the momentum on the PPO here. It is as high, as it was here in January, in April and July when we were coming off of that low point. We had that kind of move, and that's how high we got. And now, granted, the low didn't get that low, even though we probably went lower than the 200-day moving average. It was so short term that the PPO didn't get nearly as negative. So again, is that a bear market? Well, that would suggest to you no, that it's not a bear market. Just like that wasn't a bear market. It's more than just getting a death cross and makes a bear market. It's more than as we've learned in this last couple of months. It's more than a 20% pullback that creates a bear market. This obviously is not a bear market, at least in tech stocks, as we're now really, really flirting with this particular index's all-time highs. Let's take a look at the 3 green arrow charts for the S&P 500. You can see, give it a second to load up here. We are back now to 3 green arrows again. So that MACD has finally turned up. If you take a look at the 2-line versions, you can see what that looks like here. So again, this is a reflection of a bearish trend, not a bullish trend. A bullish trend, not a bearish trend. So that's a good sign, actually, that we might not reverse this to the downside, even if there's still that question mark of filling in some gaps here. The stochastics is making its way back up to the upper reversal zone as well. Now let's take a look at that intraday chart. And this is the question. Here's the issue. Like from this 286 close that we had going into expiration, we're now up to 296. So we've made a 10-point run. The problem is most of that 10-point run occurred overnight, right? So that's our issue. That's the issue we have. It was a big move on Monday, a big move on Wednesday. We haven't filled in either one of those gaps. We did fill in a little bit at the end of the day yesterday with a big jump in volume. But then you can see volume tapered right back down with the gap here today. In fact, if you take a look at today's volume and trading range, I mentioned to you the trading range was really small, but the ATR actually incorporates that gap. But look at the volume dropping all the way back down to 85 million. So light day on volume to support this little breakout that we've got going on. If you take a look at the where that fits in, so 85 million is right a little bit below that average. The trading range, 2.3 points, but you have to add in the gap. So the gap we close at 292 essentially. The low today is 295.5. So we got 3.5 points. So that puts us at almost 6 points. So below average, but not nearly as below average as what you would expect, considering the actual range here. And you can see the ATR itself is still relatively elevated, right? When you're below 1, you're on a bullish trend. When you're above 2 still, you're still elevated. And that's kind of reflective of, the daily price moves. You can see it's one thing for historical volatility to be below implied when you're on a bullish trend. I mean, that's a good sign. That's what we want to see. Here we are, we're not down to these low, stable levels of volatility. We're still at relatively elevated. Even at 28, we're further down. But if you look at my horizontal line all the way across the board, if I go back, a few years for some context here, if you look at where my line is across the board, getting up to 28 was actually a high, was a peak. It seems low now, but it would have been. I mean, it was about as high as we got during this decline. and obviously higher than any of these other intermediate pullbacks that we got. So that puts into a little bit of context, still how volatile we are, even if we're not nearly as volatile as we were. And you can see, you have big candles, relatively big. They only really exceeded the 1% mark, whereas here we're exceeding 2%, if not getting up, over here, 3% on Monday, and then close to 2%. We were closer to 2. This is the size of the gaps, right? And you can see we've had, relatively smaller gaps to begin the day, but we've had some relatively larger gaps here on Monday and Wednesday. So about 2 standard deviations from with really high deviations to begin with, anyways. So pretty decent sized moves here. Now let's take a look at the volatility index, and we see here the VIX, like I said, dropping below 30, getting into those high 20s, and dipping all the way to this 90% level, which, when we're kind of in this coming off of lows phase, that can act as a support. That can be a level that the volatility can bounce off of. So watch, this is kind of like, okay, we're at this level right now where we will either fill these in right now with a rise in volatility, which would be significant. If we got all the way to 285, there'd be a pretty significant rise in volatility off that 90% mark. We'll either fill those in with a rise in volatility, or volatility will break that 90% mark, and here we go to bullish side. Remember, a few other limits that we kind of watch for: getting above 60 here. We are at least above 100. We haven't eclipsed the 200 mark, but at least we're above 100 here. But getting above 60, getting above 30 on the DMI, at least the negative index also has to get below 20 and get above 30 on the positive. And then on the trend strength indicator, getting above 5 here, as well as above 80 down below, considering they're already above the cloud. Those are some limits that we kind of need to break to settle this trend in, as well as breaking the volatility below 90%. It's relatively rare for us to break and stay below volatility. If I were to go all the way back here a few years to kind of give you some context, when we break below the 90% mark, we're usually pretty low on volatility. Even on these other periods, by the time we broke and stayed below 90%, the volatility index had already come down to 15, right? And, well below 20. When you come over like into this area, again, coming off of this peak, by the time we had broken below 90 and stayed below, we were well below 15 on these others. If I were to go back, obviously further in time, as far back as we can go on some of these other peaks, here's 15 and 16. Again, by the time we broke below 90 and stayed below, we were at least below 20 at that level after having peaked at 30. Same thing here. When we broke below 90, we were below 20, closer to the 15. So you can see some of these others. Here's 2011, the peak we had there. By the time we broke below 90% and stayed below, so right in this area, we were right around 25. And we broke down and continue to make. So similar to where we're at right now. Over in this area, by the time we broke below 90% in 2010 and stayed below, we were around 25, 26, 25. And of course over here, by the time we broke below in July of 2009, the 90% mark, we were again down below, right around the 25. So you can kind of see, for us to break below 90, we'd want to continue to break below 25, and that would settle us in for an extended run below 90 and a bullish trend, but a more volatile bullish trend, but a bullish trend nonetheless that can establish itself and get going. And like I said, back to the market forecast with the market sentiment line on the Qs. The Qs market sentiment's already crossed above 50. When that market sentiment line crosses above 50, you can get a long-term run, right? A long-term run. Here's where it was below 50. By the time we crossed above it, even with the pullbacks, you had a good run. So getting it above 50 is a very, very good sign that, again, you would hope that it would drag the rest. We don't need outperformance in the Russell. In fact, you probably don't want it in the Russell right now, because we've seen in the short term here lately that actually precedes weakness to see IWM. So we don't necessarily need small caps to lead. We don't necessarily need value to lead, because we are well off those lows. Those are the things you want us to lead off the lows. This wasn't the case here. This is very similar to 98, where we had that deep pullback, and technology led going into the pullback, technology led during the pullback, and technology led coming out of the pullback. Very, very similar environment, and that's okay. We can, in 98, we rolled that trend for another 18 months. So, if we can ride this trend for another 16, 15, 12 months now, then so be it. We'll ride it as long as it takes us. So to summarize the outlook, we have a good bullish little breakout, and we mentioned on Monday we want to see it hold the next couple of days, and so far so good. It would have been better had we held it with a good rally again during the day today to come off of yesterday's pullback with a little dip into that gap on Monday, but hold that rally, like reverse that move with volume, with even light regular trading session volume is way more than the extremely low, thin overnight trading volume. So that's why it would have been better, but we'll see. We'll see if this gap can hold. And like I said, a lot of these S&P indicators, we've been bullish to get up to those limits, and there's a point of control on the value area at 300. There's a 200-day moving average that we're flirting with. There's a 62% level Fibonacci retracement level that everybody's talking about that we're flirting with. So we're flirting with, we've been bullish enough to get us to these limits on the RSI and on the DMI and on the trend strain and everything. But we haven't been bullish enough yet on the S&P to get us through those limits. And we really need to see that, right? To be able to say, okay, we're going to, this isn't just going to be a quick short-term strong bullish move in tech. It's going to be a bullish trend that's going to be led by tech that can last for quite a while. So what do you think? Do you agree with that assessment, or do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. You can hit either agree or disagree, and let us know. If you disagree, comment down below as to why. What are you seeing differently that makes you either a lot more bullish or a lot more bearish than what you're seeing here with our take? Now let's take a look at what's driving the price action today. So if we take a look at the long-term, different asset classes and how they've compared since Friday's close. So we're going to put it including Monday's open. This will include Monday's open here. So you can see everything opening up. And crude oil, USO at least, is having a really good move this week so far. In 3 days, strong move to the upside, 13% in 3 days on USO. IWM, small cap stocks have had a good week. They're up 7%, more than double, or about double, a little bit less than double than what the S&P has done. So good, again, it's again, we want to see that when you're coming off of lows. You don't want to see that when we're well off of lows and it's been a laggard, right? Because usually, again, that means, if the Qs were the leadership and the leadership is now underperforming, that tells us that the leadership is waning, right? At least in the short term. So just keep that in mind. The dollar is down significantly. It doesn't look like a lot, but for a currency, that's a pretty significant move to the downside, and another reason why we've been so bullish. In fact, if you look at the chart of the dollar here, let's see, the index still hasn't been fixed, that data point yet. You can see how much TD Ameritrade is concerned about their data points on their charts, but UUP at least, when we take a look at that, you see what you want to see: dark pink shading and a red line. That's what we want to see out of the dollar. We want to see a nice good run of that. We've had some of that already. We want to continue to see a good run of that because that is what leads us up, right? Weak dollar moves is what leads us up to the upside. We got light pink shading here. We need to break that, get to dark pink shading, and get a red line, right? Well, something like this. That leads to good, long, extended bullish trends to the upside, and you'll see international stocks start to, we had a good bullish trend during this run, but with the dollar being bullish, it's been all U.S. stocks. International stocks have really underperformed. And if you take a look here, your intermediate line is still, at least it's below the market sentiment. And, so there is a good sign, even while we've been trending higher, that we will move lower, and what would be a good bullish move for equities as a whole. If you take a look at yields, though, they're not anywhere close to being on a bullish trend. At least they're up a little bit here this week. If you take, we saw that bonds were down. They're not up a lot, but they're up something, and mainly from Monday. In the last couple of days, we pulled back, but there's an intermediate confirmation signal here. Not as strong as if the intermediate line was above 80, but enough of one that we might look for a bounce off of this here in Wednesday and Thursday. Again, a bounce off of this, especially if we were to be able to get above 75 basis points, would be huge for risk appetite, in terms of showing us that things are turning around, because you already see it in the crude contract, right? The crude contract got us a bullish cluster with this, at the beginning of this intermediate trend. That's a very, very good sign for risk appetite as a whole. And you can see its market sentiment's finally gotten out of the reversal zone, and it's still got a long ways to run there, but the cluster helped solidify the beginnings of this trend. As you can see, we've continued to move up to the upside. If you take a look at the economic indicators, they're still pretty light relative to their estimates. They're still pretty low too, back to 2011 levels. So we kind of want to start to see this run up. And it doesn't have to be positive, but at least it has to start trending to the upside. You can see we're at 119, which is well down, down well below actually the 2008 levels on the economic surprise index as a whole. This kind of shows us how, from an economic standpoint, how low this is, and why you shouldn't expect the Russell 2000 to lead, because the economy is not the same as the S&P or employment data points. And that a lot of times that gets pulled up. The employment numbers are so low. The economy, no, that's the stock market's not. We don't trade the economy. You trade the stock market, and eventually, long-term returns are dictated by economic growth and earnings growth. That's what long-term returns are dictated. In the short term, momentum and sentiment can be powerful factors. And right now, you have very powerful sentiment to the tune. I tweeted this out here earlier this afternoon, to the tune that the small trader, so contracts of 10 contracts or less, this small trader index has shown an extremely high number. The last time we were this extremely high was when we formed the peak going into the sell-off. So this kind of shows how strong the sentiment has been. And we've made a lot of call option trades. And again, you ride the trend as long as that trend will take us. But we don't put all of our eggs in this basket. In our class portfolios, we've been pretty balanced in what we've done. With what you get in the market outlook, a small reflection of what we do in all of our classes. But we've been pretty balanced and pretty, if we do pull back, while we do have a lot of call options, and you'll see another one tonight, we'll be fine because we have plenty of bearish delta trades through our options inventory trading, as well as other directional trades that can help offset that in the short term, while maintaining these longer term bullish delta trades. Speaking of technology's outperformance, you can see it continues to have, the technology, discretionary, communication services, they have high 90s. That's great. Materials and energies are in the mid 80s. Even financials and industrials are turning around. You're back to light green shading at least, with a rising intermediate line. You are back above 50 on industrials. You have some weakness on safe havens, which is normal. So this is kind of what we want to see now. We want to see, we don't necessarily need financials, industrials to lead these cyclical areas. We want these to be the big winners. We want these two to at least be outpacing the S&P as a whole, because that's typical, right? It's typical for these three to be higher, these two to come in. That would suggest the Russell 2000 is bullish, but it doesn't have to lead, right? If these three start lagging in the short term, with the other areas rising, kind of like what we saw today, we don't need to see more of this. We don't necessarily need to see energy making a run up, and financials and industrials outpacing these areas. We would like to see XLC, Y, and K at the top, I and F kind of below that, but still outpacing SPY, and then all your safe havens up below. Even healthcare, it would be okay, especially considering the buy the rumor, sell the news of the vaccine coming out, the impact that will have on that particular industry that had been so bullish during this cycle, up, down, and back up cycle. All right, so for our trade idea of the day, I want to take a look at Intel. Intel is a stock that has really broken out. You can see it's broken up above its highs here It got a cluster, an overbought cluster, which we like to see at the beginning of intermediate trends, right? It helps solidify that trend. So we got a cluster at the beginning of this intermediate trend, just as the intermediate line makes its way above into the upper reversal zone. Then we kind of went sideways after that, little ups and downs, and then on this latest upswing, we broke through that cluster high point. Very, very good sign from that perspective. Obviously, if you take a look at the weekly chart, you can see what it looks like here. Dark green shading, green line just starting on this weekly basis. Strong move as of right now. We got 2 days left in the weekly candle, but strong move higher in the momentum line, the near-term line coming up off of a bullish low point. So very, very good sign from that perspective. In fact, if you take a look at the weekly candles, you can see that a very good, we've had a couple transition candles here, and then we got a strong bullish move up above a rising 50-day moving average as PPO is rising. When you take a look at some of these other oscillators and you look at those limits I told you about before, well, we broke above 60 and we broke above 200. Good sign on a breakout here. You look at the DMI for Intel, and you can see we broke above 30 and we were breaking below 20 on the negative directional index, flirting with both those levels, but a good sign from that perspective. When you look at the trend strength indicator, we had pulled down, but you can see we're right back up to a weak bullish trend again, and so we have opportunity for this to trend back up to where it was. It was flirting with 80, and it was flirting with getting above 5, and now it has a chance to get back into that trend strength again. When you take a look at its Bollinger Bands here on this chart, you can see we broke up above the value area today, breaking up above the upper band. In fact, when you look at the Bollinger Bands and the Keltner channels here, you can see that we broke up above the upper band, and we're flirting with breaking up above the upper Keltner channel, and the bands widening back out again. So in other words, a squeeze play to widen back out with the band width starting rising. So we have an opportunity for a trend, a good sized move to come out of this. And so for our trade idea of the day, we took a look at buying the at the money August contract with a 50% stop order. So this kind of puts what it looks like here. So we are position size for a normal loss at our stop order, and there's a good chance, because of the breakout, there's a good chance that we can easily get out of this and we're past the earnings, so we can easily get out of this with 50% and keep our loss to that $1,000 level. And if it does make a run up to the upside, then we have some pretty decent return opportunity, and this is actually out to August expiration. We have a decent return of about $3,000 for the $1,000 at risk, and that's only if it makes a 1 standard deviation move. Obviously, if it continues even through that and beyond, considering that we are up above its value area, then we can even make more than that. And if it pulls back in the short term, because maybe the market might do that, then we've got room to work with. We've got all the way down to about the $58 level to work with, and before we start worrying about losing 50%. So you can see that would be, we can come all the way back down and still stay in the upper half of this bandwidth. You can see when you break up above the bandwidth, you've got all this room down to the bandwidth that you can still trade with and work with before we even worry about getting stopped out. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. You can comment on our tweets. You can comment on our YouTube video. You can comment on our blog at Market Scholars, or in our forums with that link popping out right there in the top right corner of your screen. But what questions or comments you have on what we talked about in the video today, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter at DavidSettle42 for more content between the videos, and join our Facebook group at our Market Outlook Facebook group, as well as our community at MarketScholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.